How did a legendary investor find Amazon and make an insane return? Well, he has something that you don't have, and without it, you'll always lose money. And this wasn't a once-off either. Over a period of 13 years where the world index doubled, he was able to make 10x with his portfolio. We're going to cover who he is and what he saw in Amazon that others missed, how he did it, and then we'll cover the 3 things that you need to master to be able to do the same. Our legendary investor is Nick Sleep, and in May 2004, in a quiet London street, he was about to make an investment in Amazon that in 10 short years would change his life forever. But let's take a step back. Back in 2001, they started the Nomad Investment Partnership, Nick and his partner Zach. In 1997, Amazon had its IPO. And at that time, it then ran through and reached its peak stock price in 1999 during the dot-com bubble. And that's when all these new internet stocks were coming out and everyone wanted to jump on the craze of investing in the next big thing. Everyone had fear of missing out. And in short, that led to an absolute mania where the stock price didn't actually match with reality and what its value was. We can see from that peak in 1999 that it took down into 2002 for the stock price and actually lost 90% of its price. From that low in 2002 up to May of 2004, that shows that the stock price recovered and probably reached back to some form of reality around there. And that is the time that our investor, Nick Sleep, made his investment, or his first investment in Amazon. Now, looking at Amazon's 2003 annual report, we can see that it's actually had its first profitable year on record, just before Nick made his investment. And that's a big turning point for the business. As well as it's seeing 74% growth per year, or year over year, in sales revenue, which is just huge. So it's a very fast growing company, and it's just had its first profitable year. Now, over the next 3 years, what did the stock price do? Nothing. It has effectively stayed flat, bounced around between a couple of points, but with all this growth going on and increased profitability and the business investing most of its resources back into the business, not a lot of other investors really took notice of it or wanted to still go near it. So while this stock price was flat, what did Nick actually see in the business and why did he hold on? So he actually had a look back at these reports, and he actually goes through some of Bezos, the CEO of the business, and had a look at how the actual business model works. And so what he saw was something that was very similar to other big businesses that had operated really well in the past. And effectively, Jeff Bezos focused solely on the customer and making sure the customer had a really good experience. And by doing that, he hoped to bring more customers. And his main focus was, if I have a really awesome customer experience, then I'm going to get more customers coming by either referrals or hearing about us. Then I'll be able to get more sellers to come on to sell more products, which then gives the customers more selection. And then it feeds back into the customer experience and makes it better. This is an image of Jeff Bezos' picture sketch from the 1990s and gives a bit of an illustration of this. But while that little loop's happening, there's another one. Any profits from the business, Jeff and the team at Amazon are actually reinvesting it into the business. And so they're lowering how much cost it has for the sellers to house their inventory or deliver their products, making it quicker deliveries, actually integrating that into the business. And that's what Nick saw. He could see that this business model had worked in the past for many different businesses. After he's waited 3 years, what actually happened? Well, it was nice, but in a short 6-month period, the stock price in 2007 grew 125%. How is Nick going to handle the worst stock market crash since the Great Depression? Well, the cracks began to show in the late 2007 through till 2008. And during that time, there are a number of other issues that popped up, another number of bankruptcies. But that whole event we call the global financial crisis. So what happened to Amazon during that time? In a news article, we can see a few different things. In October of 2008, there's a number of things that come out, and it's a bunch of analysts, so external to Amazon, that are projecting what they think Amazon's either revenues, sales forecasts, and other things like that will be. And in short, the business didn't meet or reach those numbers that they had forecast. And that news sent a ripple through the shareholders, which could be investors, long-term investors, short-term investors, traders, speculators, everything under the sun. But for some of that group, they decided, we're out. And there was another significant sell-off of the stock. What did Nick actually look at, and what did he actually care about? Well, we can glean from his insights in his interim letter of 2007. He'd actually discussed about how much he was actually going to invest in his stocks and looking after his portfolio for the fund that he actually manages for and on behalf of other investors. And he said it's actually commonplace for investment funds like his to invest maybe 1%, 2%, 3% as maximum when they first make an investment. And what he talks through is, well, that really anchors down the maximum that you can actually get. And they only allow those portions of their portfolio to grow up to a certain amount, which might be 5%, for instance, maybe even 10% for huge outliers. But that holds them back from performance. Now, he also makes a bit of a tongue-in-cheek scenario of saying, we are not advocating all the fund in Amazon. Well, not just yet, at least. And he actually states that having 1/6 of the partnership invested in a volatile stock such as Amazon is that our results will be more variable over the short term. So please bear that in mind in future performance. The volatility does not bother Zach and me one jot. And he talks through there really putting his focus on the performance over the long term is what's more important. The volatility, or where the stock price goes up and down significantly in a short term, they don't care about. As long as the business is running well, and like he'd mentioned, the actual mechanics and how the model of the business works, and that it was being run by people like Jeff Bezos that were striving to make sure that their vision for where the business was going and executing on that vision. In his interim letter of 2007, going on a bit further, he actually talks about how different investments that they'd invested in earlier on in this partnership with Conseco and Stagecoach has helped us continue to own Amazon. So a large portion of Nomad's performance in that 2007 period came from the lessons they'd learnt from mistakes in 2003 and 2004. And he says to think of it as return on prior year's losses, which is a really important way to think about learning over time and getting better. In his annual letter of 2008, he actually talks about what he's actually looking forward to. So this is during the time of the GFC. And he says, thinking about where the business is in terms of Amazon and online retail, we're now almost 2 decades further on, and buying something online is much more normalized. But back then, not everyone, or not even like 50% of people would be playing around and buying things online. He has a little bit of a think about it. He says if Amazon can pick up $1 in 10 of their main street rivals, for instance, like the brick and mortar stores that actually sell these products usually, then this alone would be enough to quadruple Amazon's US revenues over the next decade. And that's a lot of runway for a business like Amazon to be able to grow and continue to grab some of that market share. In his interim letter for 2009, he actually puts in and compares what the actual stock price was, where it jumped around between $100 and then back down to $40 over that period. And he compares it against the actual revenues per quarter, and he can actually show that it's very consistently growing revenues, consistently quarter over quarter, and even through the GFC. So how did Nick actually go? Well, from that low in 2008, over the next 3 years, the stock price grew 381%. But in 2011, the stock price dropped 30% in a 2-month period. What was going on, and what did Nick actually do? So in this article, where it goes through in October of 2011, it discusses a few different things and talks about the net profit declined 33% in the third quarter compared to what it was a year ago. Analysts have forecast what they believed the business should be doing in terms of its revenue for the year. And even though the revenue was up 44% to 10.35 billion, it was still slightly below the 10.5 billion forecast by analysts. So not forecast by the business, like from Amazon itself, it was forecast by external analysts, either on Wall Street, main firms, and other investment houses. And that resulted in that decrease in the stock price. Let's see what Nick actually thought about it and when he reflected on it in his previous letters. So in his interim letter of 2009, he's talking about the investment spending of the businesses that they own. So in Amazon in particular, he's actually talking about where have these profits of the business actually gone. If revenues are still growing consistently, where's all the money going? And so we've spoken about this before, but let's see what Amazon was doing. He talks about choose to lower their revenues by between 700 million to 3.4 billion last year as an investment in the future. And so including this sum, Amazon will have invested between 4.8 and 7.5 billion last year, which is around 14 to 21% of their revenues. That's a huge amount. In his annual letter of 2011, he says, the simple deep reality for many of our firms is the virtuous spiral. And so he's established this when companies keep costs down, margins low, and in doing so, they're growing scale with their customers. Further on in that 2011 report, he's talking about all his other investments as well, saying Nomad's firms are, on average, so cost advantaged compared to many of their competitors that the worse it gets for the economy, the better it gets for our firms from a competitive position. The trick to being a good investor over the long term is to maintain your long-term oriented discipline. And so this reflects back to the GFC during that time when the stock price crashed again, and then through to this one in 2011 where it dropped by 30% in 2 months. From Nick's 2012 annual letter, he actually puts a quote in from Alice in Wonderland from The White Rabbit, saying, "Don't just do something, stand there," which is a great quote for some of this long-term investing in general, which is being able to check what you're doing and stop. At the end of the day, not changing an investment, either reducing an amount or buying or selling anything, as long as your investments that you currently hold, underlying the businesses are going all right and everything's growing, it's perfect. Let it run. So from 2011 through to 2014, the stock price for Amazon recovered pretty well. And that short blip on that 30% drop was inconsequential. Now, in 2014 is actually at the time that Nick decided to shut down his Nomad investment partnership with his partner, Zach. So what did Nick actually do with his portion that was invested in the partnership? Well, he decided to actually take it out and put it into a charity that he created. Now, it's called the IGY Foundation, and he's actually allocating capital to both sides. Capital in the stock market to continue to grow the amount of money that's in the charity, so the future donations can continue to grow, as well as donating that money to the other charities and other causes that he is then reviewing to make sure that they've got the biggest bang for the buck. Is he getting the best value for money in terms of where he can put this money to work for the greater good? And so in less than 10 years, he's been able to effectively triple his investment. His entire portion that he had given to the charity has been able to be donated entirely, and he's still got double his original amount in the investments of the charity, and that's how much it's grown. So pretty incredible. He's still an exceptional investor. He's still doing the work. Now, how did Amazon go? Well, if you thought you were late to the party in 2014, you were wrong. Because from there up till 2025, the stock 11x'd. And this just shows the compounding effect of finding a great business early on in its life and holding on to it and letting it run. So here's the 3 lessons that you need to master. Now, the real lesson here isn't just buy Amazon. It's not hold stocks forever. It's not get a time machine, jump in the DeLorean and hit 88 miles per hour and then go and invest in Amazon. The real lesson here is long-term patience. So, step 1, you need to understand the business. So for Nick, he understood how fundamentally the business made money and where they put that money to work. So for Amazon in particular, they were investing in building out the infrastructure and continuing to grow that business, and their moat or their competitive advantage was to make sure they had the lowest costs and best customer experience to make sure more customers wanted to come and buy from Amazon's platform. Now, Warren Buffett calls understanding the business staying within your circle of competence. So if you step out of that area that you know, or the businesses that you know well, you're going to find things that are going to make you lose money. 2, you need to separate price from value. So price is what you pay and value is what you get. But what does that actually mean? So during that time, while Nick was holding Amazon, what was the right thing to do? Lots of people might wait until the price increases and then sell it and say, woohoo, I've made a profit in 6 months of 125x my original investment. Watch it decrease, and then over the next 10, 20 years, see the stock market truly reflect the business value, and you've missed out on the huge gain. You've taken the little peanuts at the front. When the stock market crashes though, you've got to be able to stop and think and be able to see that the price that the stock market says or other shareholders say it is, or they're willing to pay for it, take that and separate it away from the actual underlying business. And so for Nick, when he had a look at the revenues growing, the actual business, the strategy that Jeff Bezos and the team were actually doing, everything was still working. 3, you need to have confidence in yourself and making those decisions before you actually need it. So you can't actually build that up at the time that you need it. You need to do the hard work before you get to it. Because otherwise, shit's already hit the fan. Like, there's not a lot you can do. And literally during the GFC and other recessions and things like that, people are literally running around like headless chooks. So how do you actually build confidence? Well, here's how I like to think about it in terms of investing. You need to know the right things. You need to know how to do the right things. And you need to know how to do the right things when it counts. That's where the real magic happens. Without one of those things, either if you don't know the right things to do, you'll make mistakes. If you know the right things, but you have no idea how to actually apply them to what you're doing in the stock market, you're going to have problems. And even if you've got the knowledge, you've got the skills and experience, but as soon as times get hard and your emotions start to play out, the stock market's going through the roof, you've got fear of missing out, or it's coming back down and you're freaking out, you just want to get all your money out and just protect it, you're going to make mistakes. And so that's why it's really important to make sure you've got those 3 things. Now, if you don't know how to understand a business, you don't know how to value a business or separate that price from the value, and you don't know how to build your confidence in the stock market or investing, check out the link in the description. It's where I run through and share everything I've learned in my time. So it's free, link in the description, check it out. Now that you know how to hold on to a great business, you need to be able to spot losing investments so you can avoid them, because losing money sucks. I'll show you my 5-step framework that I learned from Warren Buffett that saves me from losing money. Watch it now.